Good evening and thank you to all the interested participants who have joined this evening. We are about to begin WiseViews session number 218. We are joined already by Mr. Mallikarjuna. Welcome, sir. Thank you so much for joining. It's a great pleasure to introduce Mr. Mallikarjuna Garu. I'll just share my screen. So WiseViews leadership conversations are held every Friday at 6:30 p.m. and we have reached the session number 218 this evening. As I mentioned, Mr. Mallikarjuna Rao has already joined us and we are waiting to learn from him on the consolidation of PSBs in India and how it can be a catalyst for higher economic growth. We will wait for learning from him. So this introduction and his opening remarks will be for about 20-25 minutes. And after that, we'll have 40 minutes of Q&A in two clusters. My privilege and pleasure and honor to introduce Sir here. He was the former MD and CEO of two big banks, Punjab National Bank and Allahabad Bank. He was also the executive director on Syndicate Bank. After that, currently, he's an independent director on the board of Axis Bank, director on IFTAS, the Indian Financial Technology and Allied Services, which is a wholly owned subsidiary of RBI, and on various other boards like Nuclear Power Corporation Limited. The journey is very interesting, and he's a veteran banker. He worked with the Bank of Maharashtra, he worked with Global Trust Bank, he worked with Oriental Bank of Commerce, and some of the key accomplishments during his long journey are the following. He successfully implemented business transformation in Allahabad Bank and ensured that Allahabad Bank has been brought out of prompt corrective action PCA imposed by RBI earlier in February 2019. He achieved amalgamation of OBC and Union Bank of India into Punjab National Bank involving business integration, technology integration, and human resources integration. It is a CEO's playbook and not easy at all. Post-amalgamation, organizational restructuring has been implemented successfully in PNB, with more than 10,000 branches and more than 100,000 of employees. PNB International Limited has been brought out of watch list of PRA, London, through focused implementation of remediation plan. That is fantastic. And he holds a BSc in Maths, Physics and Chemistry, LLB General, and CAIIB. Apart from that, some prestigious leadership programs that he has attended at IIM Allahabad and also at the University of Buffalo, USA, and an executive program in predictive analytics in Ghent University, Belgium. So with this, I once again welcome you, sir. Thank you so much for joining us. Give me one more minute. I will welcome my esteemed colleague, Dr. Prasad, Senior Director of Academic Wing in ICFAI Group. He brings 3 decades of rich experience as an entrepreneur, as a corporate professional, and as a consummate academic right now at ICFAI. He holds BTech from IIT Bombay and PGDM from the prestigious IIM Kolkata. Welcome, Professor. Thank you so much, and we look forward to having a great conversation this evening. I'll stop sharing the screen. Sir, Mallikarjuna, sir, once again, thank you so much for joining us and sparing your time.
Thank you.
Thank you. I welcome all the distinguished members who have joined around the screen. A large number of them have joined today, both on Zoom as well as Facebook Live. Over to you, sir. Thank you once again.
Good evening to all of you. Thanks for the introduction, Sudhakar Garu. The subject probably may appear to be a little different if you look at only the concentration is only on public sector banks. The reason why I mentioned, if you look at as on today, the commercial banks are very critical for the growth of economy, for any developing economy, any emerging economy. There's no doubt about it. However, in our country, we have seen the transformation in our economy and the financial inclusion, more importantly, after the public sector banks have come into action. We'll just have a look at the vintage and see how the journey has taken place by spending a brief amount of time, which will give us the orientation to understand how in future when we want to become a developed or good economy, or what we are calling currently as now currently at 4th level, but we want to reach 5 trillion economy. How we can achieve that and how the banks can take part is a very important thing. Now, if you look at the genesis of public sector banks in India, everybody knows about it. But then, just to have a prelude to our discussion, formation of State Bank of India took place in 1955. We have seen 14 major banks nationalized in 1969, and further 6 banks nationalized in 1980, based on certain criteria as on that date. 50 crores was in 1969 and 200 crores deposits were in 1980. What they have achieved out of this? They have achieved social control and financial inclusion. The government is able to see that the banks go to the rural and semi-urban areas while opening the branches for financial inclusion, and credit control for economic development. Otherwise, earlier the bank's objective was only profit motivation, and wherever there is an opportunity to earn a profit, they were concentrating there. It was not viable for them to go to rural and semi-urban upcountry locations. As a result, the growth was centered only around urban and business oriented locations. So with nationalization, the government has ensured that from 1969 and 1980 onwards, social control and financial inclusion, credit control for economic development. Now, how the outreach has gone ahead. Bank branches established have increased across the unbanked regions, particularly in rural and semi-urban. In 1969, there were only total 8,000 and odd branches, whereas today we have more than 1,65,66,000 branches across the country of the commercial banks. And by 2015, when the Jan Dhan Yojana was 2014, when the Jan Dhan Yojana was triggered further to accelerate the growth of financial inclusion, the branch network at that time was 1,25,000. So you can see how the enhancement has taken place. Now, the outreach also has ensured that public trust due to government ownership, because the government has been owning the banks, there has been an enhanced public trust. And by 1991, 90% of the banking business is held by public sector banks. Because why I have taken the year 91 is because from 69 and 80, of 2 bouts of nationalization, the branch network has gone very high, and it has reached the pinnacle status by which time the 90% of the banking business is held by public sector banks. And after 91, we have seen many changes, that is milestone changes in terms of prudential norms, as well as giving licenses to new private sector banks. That has again brought a different dimension of commercial banking in the space of Indian economy. In terms of financial inclusion, focused approach to private sector, priority sector lending through service area approach was introduced in 1969. Along with that, nationalization, that is service area approach is selectively the areas were identified, allocated to bank branches for development. Implementation of JAM Trinity in 2014 has further triggered and taken into the different trajectory with respect to the development in terms of financial inclusion and contributing to the development across the country uniformly. Direct benefit transfer was again a wonderful tool wherein government ensured transparency in subsidy transfer by removing the leakages. Next, what impact it has created in terms of the economy. Whatever public sector banks have come into force from the year 1969. GDP, if you see, has grown from 4% in 1970 to 6.7% in 2000s and 8.15% in 2020s. And now currently we are expecting the growth anything around 7.2%. While the growth might vary over the years depending upon the situation. If you look at the COVID impact has brought down the GDP growth. Once again, afterwards, the GDP has grown very well. Today, if you look at our country, is one of the fastest growing economies. If you look at the any economy, if you look at the important growth arrives only when infrastructure development takes place, and there is a growth in industries which can provide employment, and there is a growth in priority sector which ensures the financial inclusion in terms of providing credit to everyone across the country. So the infrastructure financing, almost bank credit, if a bank is giving a credit, 34% of it almost is going to the infrastructure, and industry and services sector at 55%, which internally includes the infrastructure. Then priority sector, as I have indicated, 40% of the profile. Anyway, RBI mandates that and every bank does it. Institutional rural credit. If you look at the nationalization impact, once again, institutional rural credit was only 29% in the year 1971, which has reached and stabilized at around 72% now. And non-institutional rural credit, which used to be at 71%, has come down to 28%, which clearly indicates when the people who were accessing credit from money lenders and other people dependent on them only, even though they were charging very high interest rates. We have come a long way after the nationalization. The challenges what we have gone through in this phase have been computerization in phase 1 in the year 1990. Reserve Bank of India has thought that current working based on the technological developments which are taking place across other industries, banking cannot be kept aside, and Dr. Rangarajan Committee recommendations were accepted by RBI for implementation in the banking in the first phase, which has happened in the year 1990. Then globalization has come into picture, and when India was intertwining itself with the global norms, Basel Committee recommendations came, and it has implemented prudential norms across all the banks. That was a very challenging period for the banks, because for the first time the banks' balance sheets appeared to be little tough in terms of identification of non-performing assets, and it took quite some time for the banks to come out of that impact. By 3-4 years after implementation of prudential norms, the banks have come a long way, public sector banks, and started listing by increasing the confidence of the public. State Bank of India was the first in 1993, followed by Bank of Baroda in 96 and Corporation Bank in 97, and so forth. All the public sector banks have gone for listing, increasing further confidence in the public by going to the public. Second, upgradation of technology came in phase 2. In fact, during the time of public sector listing only, RBI started giving licenses for the new private sector banks. We will discuss those details little later. Now, coming to technology upgradation in phase 2, it is the adoption of alternate delivery channels, then core banking solution. That means completely whatever computerization has happened in the year 1990 was almost, it has only lived for a brief period of time, and new technologies have come, providing more and more ease for banking operations. Then again, between the year 2002 and 2007, we have seen enormous amount of infrastructure development in the country. As a result, commercial banks, more importantly public sector banks, have lent to infrastructure. Infrastructure including the road segment, steel segment, and power segment. Those days when the infrastructure was heading very high, we have seen quite a few problems faced by the banks, whether it is called as a non-availability of single window for approvals in terms of road segment, and even the prices of steel across the globe, and even the import of steel from China, then power sector. These problems have created in such a way that the credit profile had been affected. Then came in the year 2014, asset quality review undertaken by Reserve Bank of India, as a result of which the NPS of the public sector banks have gone as high as almost 9, gross NPS gone as high as more than 9 to 12%. That is the time when the government also has understood the inherent problems, external problems of these infrastructure segment. They brought about minimum import price in terms of steel in May 2015 and anti-dumping tax in controlling the particularly the domestic industry. And at the same time, we have seen moderation in the global prices of steel, which has benefited majority of the ongoing steel industry, leaving aside those which were in trouble, which had to be addressed differently. Similarly, in road segment, government has brought about single window concept, and also introduced hybrid annuity model in funding. As a result, the failures have become very, very low. Even if external factors are there, even if acquisition of land is not 100%, there were, even if you cross 75%, the toll collection was permitted by that model. So these, and then government also has brought about Uday scheme, a reform scheme in power sector. As a result of this, the problems faced by the commercial banks or majority public sector banks in lending to infrastructure, whereupon bigger accounts and huge amounts have become NPA, those root cause analysis after understanding, the government has addressed them. As a result, today we see that the infrastructure development is happening extremely well without much of an impact on the quality of the assets. Now, those which remained as old accounts struck in terms of what you call money of the banks, even though there were ongoing concerns because of EBITDA not being positive. The IBC Act came into picture in 2016, and we have seen a lot of cases being resolved through IBC. All the units which are ongoing concerns, who are ridden with the debt burden, who are unable to even service the interest, they were all taken to the logical end, and now majority of them are doing extremely well after going through the what you call IBC code. Then in the year to the effect of asset quality review has fallen on banks in such a way that their profitability was impacted, capital has erosion, and they were not able to maintain the return on assets. Return on assets is nothing but the ratio of profitability. Now, as a result, at that time when 20 public sector banks were there, as many as 11 public sector banks were under prompt corrective action imposed by RBI during the year 2015 to 2017. Now, what has happened afterwards? What triggered consolidation? We shall be discussing. With respect to as I was indicating about new private sector banks which were given license in 1994, this has brought a different level playing field in the economy in terms of the banking. Significant mergers also have taken place during that period. Small private sector banks merging into bigger banks, naming a few: Centurion Bank of Punjab, first Centurion Bank, then Bank of Punjab, both have become Centurion Bank of Punjab, and again it was merged with HDFC Bank, then Lord Krishna Bank getting merged with HDFC Bank. Similarly, quite a few banks. And we have seen few private sector banks coming into public sector. For example, Nedungudi Bank has been merged with Punjab National Bank. Global Trust Bank has merged with Oriental Bank of Commerce. Then we have also seen associate banks of State Bank of India getting merged into State Bank of India. This merger has happened as a normal process, because you must be aware, mergers and amalgamations have been in force from time immemorial across the globe. Depending upon the business needs, this convergence does happen. Now, coming to technological landscape, after the emergence of new private sector banks, we have seen a lot of changes in the technology. Like I have indicated about technology upgradation at the phase 2 level, UPI revolution everybody has seen in digitalization, and banking operations through multi-channels today. And then collaboration with fintechs is the order of the day today, when banking services are being extended to various customers. Now, coming to what has happened after prompt corrective action between 2017 and 2019, the banks were starving. Commercial bank, particularly public sector banks, were starving for capital. Now, owned by the government, even if it wanted the public sector banks to go to the public for raising the capital, the public was not having confidence because of prompt corrective action and restrictions in terms of the growth of the banks. Then came massive recapitalization with a size of 2.11 lakh crore government has infused as a capital. And additionally, to address issues related to capital adequacy, provisioning for NPS, and to boost credit flow, total infusion of capital reached 3.12 lakh crore by July 19 from the government as well as from the market. Some of the banks not only have taken from the government but also have gone to the market through QIP process. So by 2009 July, the capital infusion was almost 3.12 lakh crore. This is the time when in the last 2 years, from 2017 to 19, even the performance also has improved for the public sector banks. All the banks under PCA framework improved performance and booked consistent profits. So recapitalization has improved the capital adequacy and other critical regulatory requirements, as a result of which Reserve Bank of India has lifted PCA restrictions on all the banks by March 2019. Again, now the full circle has come with respect to the public sector banks in terms of their performance and providing impetus in the economy. Now, why the consolidation has taken place? By 2019 July, when all the banks have come out of PCA, by August 2019, government has declared that there will be a consolidation among the public sector banks. What are the determining factors? See, as on that date, we have 20 public sector banks extending similar products and services. Growth projectile of economy requiring higher risk appetite from banks. We used to have consortium lending involving many banks to corporates. If a corporate required a higher outlay of credit, one bank was not able to give, there were many banks. This used to impact the operational flexibility in terms of decision making, in terms of servicing the customer. And we have been living with this for quite some time. This is one of the driving forces for the government to think that the risk appetite for the banks need to be upgraded by creating consolidation. Then performance management and ownership control by the government on as high as 20 banks. It was not probably, it was probably government was thinking that it was too high. We need to look at consolidation. Competition among the PSBs in many segments and geographies, in among themselves only. The competition is there in among themselves. So these are all the determining factors whereby government has issued a notification. On test basis, they have merged Vijaya Bank and Dena Bank with Bank of Baroda, effective from 2019 March and 2019 April. After seeing that their merger was smooth, they have declared that 10 more banks will become 4 banks. They are Oriental Bank of Commerce and United Bank of India getting merged to Punjab National Bank, Syndicate Bank getting merged to Canara Bank, Andhra Bank and Corporation Bank getting merged to Union Bank of India, Allahabad Bank getting merged to Indian Bank. While the geographical consideration was also one of the reasons, but the predominant consideration was the core banking application which was being run by these banks, facilitating the merger among themselves. Now, when we look at this is the background of how the public sector has grown in our country over a period of so many decades since 1969, and how they have been instrumental in increasing our growth in the economy of our country. We are now on the cusp in a situation where we want to ambitiously grow to 5 trillion, become a 5 trillion economy, and probably the entire global countries, that means various emerging developed countries, they're all expecting that the India might become third largest economy in the years to come. So what is that imperatives we are looking at from emerging economies to the developed economies? Sustained high growth, average real growth of 7.8% over 2 decades. We need to continuously grow over 2 decades. You kindly look at when the GDP is growing, unless there is a credit growth simultaneously, at least to the extent of 2.5 to 3%, it would be very difficult. Investment rate of around 40% to GDP to be achieved by 2035. Resilience of financial sector, continuous infrastructure development, human capital and social development, structural reforms, innovation and technology, global integration and competitiveness. These are all the imperatives. Now, for these imperatives, we have the role of commercial banks, especially the PSBs, supporting key growth sectors, including infrastructure sectors, continued focus on financial inclusion and digital transformation, ensure governance and efficiency to boost financial stability and global competitiveness. We are on the path, and today all commercial banks will have to contribute, and there is a renewed and enhanced responsibility on the part of public sector banks to be a catalyst in higher economic growth. To have an ambition is one thing, but to work towards achieving the ambition is very, very important, which requires meticulous approach. Now, on this note, I stop here with my brief presentation and I leave it for the interaction. Thank you.
Thank you, sir. Thank you very much. That's a pretty exhaustive coverage of the topic in terms of consolidation of PSBs. Thank you so much, sir, for attempting that. Given the topic, we need to probably go a little slow. That's my understanding, or that's the need. But for the benefit of large number of people, let me put some numbers and contextualize. And from there, I will request you to take it forward in the Q&A. The public sector banks story is like this. 1.41 lakh crores net profit by PSBs in the financial year 2023-24, which is the highest ever. Second, NPO ratio came down from 14.6% in 2017-18 to 3.1% in 2024, which is a remarkable turnaround. And the third number is approximately about 27 banks merged into 12 between the years 2017 to 2020, which is making the PSBs stronger, leaner, and more efficient because of digitalization and other competitive measures that are brought in. So what is driving this transformation and how is this consolidation shaping India's economic future is what we will learn from in the Q&A. Should India take that next step of further consolidation, and more importantly, how that is going to fuel the higher economic growth? So if this is what we can look at in the two clusters of the Q&A that we have, we will be very happy. And I'll now request, without much ado, Professor Prasad to start the first cluster of Q&A. And those people who have raised hands, I want to inform you that your questions will be taken up in the second cluster when I come back, and I'll open the mic for you to speak to the leader directly as well. In the meantime, you can keep punching your questions. Over to you, Professor Prasad. Thank you so much.
Thank you, Professor Rao. Thank you, sir, for introducing a very vital dimension of the growth that we need to see. So I will look at it in two dimensions in the beginning. First is the opportunity and second is the risk. So my first question is on the opportunity. In the last slide, you have introduced it to that extent, but I'll make it a little more specific so that we can understand.
Sure.
The World Bank has income thresholds for low income, lower middle income, upper middle income on a per capita basis. And India is currently a lower middle income kind of economy on a per capita basis. Of course, it is looking to be a developed economy in about 2 decades' time. Now, given what the PSUs and the other banks are doing, what needs to be done for this to be achieved? Can we be a little more specific on the last slide in terms of both your experience as well as what is practically doable?
Right.
Yes.
Yeah, can you go ahead?
Yes, sir, please.
Right. See, if you even look at that income criteria within the country and bifurcate among rural, semi-urban, and then urban and metro, you will have again a different picture appearing in front of you. The figures will be very varying in nature. It is because, in spite of many initiatives taken and reforms brought about in various sectors, we are yet to see impact in terms of reforms in agriculture. That is one of the very important areas in our country. While the attempts were made a few years back, but we have not seen very headway. That is one of the factors why we are not able to increase the per capita at the rural level. The second, after agriculture, then comes the manufacturing sector, where if you have seen, the government for the last almost 10 years has been harping on make in India approach. Unknowingly or unknowingly, in the last 3 decades earlier, we ourselves have contributed to killing of our own small industries. Those days we used to call village and cottage industry small scale industry. When we started importing goods from none other than China, specifically, or bigger countries, where at a lower cost a good quality product is available, and as a result of which our local products have gone. So we ourselves have contributed to downfall of our village and cottage industry and small scale industry. Thereby, even skill did not continue. The people had to depend on like construction, labor and other things, because there was no demand for them, and that's how the skill has gone. That's how the industry also has lost. So as a result, which actually should have been triggered as a very huge impact in terms of employment generation and economy generation in rural and urban, got impacted for the last 3 to 4 decades. Now the government has taken an initiative, which is very critical. See, if you look at overall in economy, while you can see that the growth is very good, distributed growth in all sectors is what is very important. I'll just give one example of initiative taken by Uttar Pradesh government, where they brought about OD, one district, one product scheme, ODOP. That means they have identified each district where the product is very critical, and they have given impetus to the product, and they are able to create a market. Please remember, that is small scale sector or MSME sector do not carry capability to create the market for themselves. There should be a help from the government to create the market. They can manufacture, but market cannot be created. That is the problem of smaller sector. So these are the issues where, while the initiatives are taken by the respective number one, central government, but we need equitable initiatives required to be taken by the state governments across the country in order to create an impact. So the second segment which is contributing to the GDP is the manufacturing sector. Tertiary, that is regarding services sector, we are doing extremely well, and services sector ensures people's migration from the rural to urban location where the sectoral offices or development is located. So if you look at all the 3 areas, probably our concentration is more required in agriculture and manufacturing segment.
Excellent, sir. I think you have given in specific examples the highlights of where the attention has to grow and where the involvement of public sector banks as well as the government needs to be. You have highlighted the agriculture sector. You also pointed out about the small scale sector and the deterioration which took place in the intermediate period. And you also highlighted a model which is used in UP and how what can be done and the role of the government, which is complementary to that extent. Thank you, sir. Thank you. I'll take it to the next question, sir. And this is on the risks. There seems to be a good opportunity here, and obviously with opportunity, risks also come. One of the audiences has asked a question. When you do this, would it lead to a indigo? I mean, they've taken a reflection indigo-like situation where there's a lot of impact, and would it not be on a larger scale if things go wrong? And you could have external issues, monopolistic tendencies, reduced competition, weakening of small finance banks, weakening of customer service, internal issues, job losses, cultural issues, employee union resistance. Now, how are these risks planned to be mitigated? You have a lot of experience in this, sir. Yes, sir.
The first thing is today 20 banks have become 12 banks. So there is a very good distribution of risk among the public sector, and we have dominant private sector banks. That means premier private sector banks like HDFC, ICICI, Axis Bank, and Kotak Mahindra Bank, and so others which are small in vertical size. So if you look at the economy space for the banking related, it is well distributed. I don't think there is a monopolistic approach at this point of time. Now, let us see if government is thinking of further consolidating with an objective of having bigger banks which can be reckoned across the globe. Now, while there has been a lot of discussion in the social media in the last 1 month, recently when the parliament discussion has taken place in parliament, the minister has given a reply saying that as on date, they don't have a proposal on their hand for the consolidation. Now we'll keep that aside and we will discuss what is thinking even if consolidation takes place. Now the point is basically the risk appetite is required for a bigger organization to cater to the requirement of the emerging economy like our country where the outlay of lending has increased. However, if you want to grow in credit, as I've said earlier, maybe 2.5 to 2.75 times of the GDP growth you can make. So majority of our lending is for the domestic demand. We are not lending for the foreign demand. So when we are lending for the domestic demand, when we are catering to the requirement of domestic demand, when we are growing a GDP at 7 or 7.5% consistently, there is a limitation to that extent for the growth of public sector banks. And if we go by today, public sector or private sector, if we go by today's size and compare with the global banks, even if we grow in the next 5 to 6 years at 7.5% GDP and credit growth may be around 14 to 15%, still we will not be able to reach anything below 10 position. That is a fact. When that is a fact, our objective will be to look at a domestic credit growth and move forward. Now, monopolistic position will never come in commercial banking because if you look at, while amalgamation is happening among the private sector and consolidation is happening at the public sector, simultaneously, the licenses are being given to the new banks as well to create the ecosystem properly. The cake is available for everybody to eat in the economy. As far as financial sector is concerned, convergence towards one big bank or few big banks or amalgamations are a natural phenomena of change in the economy rather than any intentional approach. Simultaneously, recently we have seen one small finance bank has been given upgraded license to become a universal bank in the days to come. So RBI is open in opening the opportunity for the new banks to come. At the same time, they want to see that the consolidation should happen by implementing proper risk management techniques in them so that they can take care of the requirement of the economy. Now, today, as on today, there are 3 banks which are considered as domestically, systematically important banks. They are State Bank of India, HDFC Bank and ICICI Bank. In days to come, probably some more banks will go into that category. What does it mean? There are 2 big banks to fail, in which case there is a renewed regulation on them in terms of capital adequacy and other requirements.
Fantastic, sir. I think you have defined it and scoped the landscape. And you mentioned that the aspiration is not towards the global side, but to serve the domestic side. And that even if we grow as per what is planned, the size still remains much lesser than what a global size. And therefore, the risk to that extent is much more limited than what may otherwise seem. Thank you, sir. I think you've also highlighted the categories of banks which are going to become or which are too big to fail, which is also one of the questions. And I think you have highlighted those 3 banks and that there could be possibly more but they're yet to come in. Yes, sir. This leads me to the next question. And this question is that, there has been a lot of consolidation, and at the same time, there are more licenses to payment banks, small finance banks, more NBFCs. Now, how do we understand this dichotomy as a part of the overall approach?
Right. See, NBFC segment is like a parallel shadow banking in any economy for that matter. And we need to live with both segments, because reaching to the customer, that last mile connect with the customer, and effective turnaround time. When the organizations are moving to become big and catering to the requirement of overall economy, concentration moves towards industrial segment, agriculture segment, and then other services sector. Then what it becomes challenging is to ensure to maintain last mile connect and turnaround time. That is where the role of NBFCs and microfinance institutions come into picture. Even if the lending rate is a little higher than the commercial banks, but their approach, that is last mile connect with the needy person at the grassroots level, and the way they can give an effective turnaround time, will really soothe the position for them for the access of credit, so that they don't have to depend on non-institutional credit. So existence of NBFC and MFI along with the commercial banks is not a situation of dichotomy, but it is a complementary situation for among all the three for the growth of economy. So there is no doubt as far as that is concerned. Now, consolidation on the one side, new licenses on the other side. If you look at when Dr. Raghuram Rajan was there as a governor of RBI, he has started at that time giving license to payment banks and small finance banks. These are two different segments, probably were being serviced by all the banks together. So he thought probably, or in the economy, the thinking in the government was that specialized segments can be addressed because digitalization was taking place very high. So with a restricted way of business, how they can do, these licenses were given. So the only opportunity for small finance banks is that after doing well and managing the financial resilience in their working, they can be upgraded to become universal banks. That's what we have seen recently, one license coming back. So issuing of a license for fresh banks and creating consolidation among the banks, once again, I would like to very clearly say, is not a activity opposite to each other. It is a natural process. Somebody big, they want to come together and becoming big to serve a different segment of the society. And small finance banks are there. They would like to become commercial banks, but to serve the different segment of the society. Our country is so huge with such a population that all the segments need different players to serve them. So this coexistence is good for the economy of the country.
I think that's a wonderful response, sir. The landscape is pretty big, and you have positioned the NBFCs at the last mile, and you're going to do better for customer service at that level. When the attention of the very large banks go towards the end of agriculture as well as industry, you also brought in the value chain at the opening end of the value chain, the small finance banks, which can work in restricted territory and aspire to become larger banks, so that larger banks are free to move into the next stage of their particular growth. Thank you, sir. Sir, now my next question is related to technology. And in this, there are two dimensions to it. First is the AI side, and the other is the fintech side. So if you look at both these sides, and you are currently on the committee as far as the RBI goes, now if you look at AI too, there are issues of both opportunities and risks, and kind of scaffolding and which needs to be done. Now, if you look at that, what do you think? Where do you position the role of AI and fintech, and what can be done to make that those dimensions more productive to the landscape that you have been describing?
Correct. Now, first I'll talk about fintechs. Fintechs have been in the ecosystem almost for the last decade almost. If you look at when in 2011, the micro ATM network came in financial inclusion further by implementing ultra small branches and other things. it was not the role of banks that they could have gone as a business correspondent. So business correspondent by name, another company came predominantly handling the technology-driven banking operations, which we can say in general fintechs. And there was a convergence even when the business correspondents, various agencies have started functioning from 2011, and until now, if you see in the last almost 1.5 decades, there has been a good amount of convergence, and now strong fintechs have come into picture with respect to working as an extended hand of commercial banks to reach out to the customers at one level. Second, we have seen fintechs coming in providing advanced technology, which you can call as a top-up on the core banking solution. Core banking solution in the banks is called a transactional banking. When we call it as a transactional banking, we cannot do more maneuvers on transactional banking, which will be impacting the overall core banking position. So you need to create certain top-ups. When you want to create a top-up, the top-ups could be based on the sectors of the customers. Exporter may require something, and industrial customer may require something, retail customer may require something. And when the digitalization is moving towards branchless banking, concentrating on internet banking and mobile banking, the role of fintechs have become much more pronounced. So as a result, we have seen fintechs providing different applications to the banks. So today, if you look at the relationship of fintechs with the banking, is interdependency on both one on the other. While you are depending more on fintechs, and fintechs are coming naturally in technology, the more and more you are collaborating, more and more the domain is also open to be careful in terms of the security related issues, whether it is called information security or cyber security. Without taking much time, I will only give one reference of the speech given by earlier Reserve Bank of India Governor, Mr. Shaktikanta Das. What he said is that while the commercial banks, which are called regulated entities, are controlled by the Reserve Bank of India in terms of their outlay in information security standards and cyber security standards, the fintech companies are not controlled by them. So today, by opening our APIs to fintech companies, we are allowing our domain of WAN, wide area network, to be used by them. When they are entering, the governor found that whatever regulation is applicable to you, you need to ensure that such kind of compliance is undertaken by them before they reach out to or enter into your domain. If you are doing that, the risks can be controlled and they will be visible to you if at all something is cropping up. So fintechs, we have come a long way. Now we are in a situation where interdependency will be moving forward with a proper cohesive working in extending the service to the customers. Now we'll come to AI, artificial intelligence. AI is like a I'll just give one sentence, not negatively. When the Satyam fiasco has happened, Ramalinga Raju has given a statement saying that I was riding a tiger, not knowing as to how I can control to ride. So AI is as good and as efficient and applicable for implementation at our end. At the same time, if we do not know the outcomes, what AI is going to create, it will be a disaster for the financial industry. So we have to be very conscious of it. Why it is so? Because AI learns on its own, on the fly, while it is implementing itself. Whereas all other reconciliation related to technology, robotic processes, automation, we have already done, which we cannot be misunderstanding as an AI. AI is completely different. Now, if AI, can we say that we cannot implement AI? No. AI we have to adapt. But where to adapt, and we can create, and when we can create, the maturity of AI models in our working is a critical factor. This maturity might come in 6 months, or it can take 2-3 years. So in banks, what probably current initiatives are being taken is at the customer interaction level, from the customer support executives or call centers. That is one area where AI is being implemented to standardize the reply to the queries, initially being given by the executives, individuals, but then will be taken over by the AI, because there is a element of maturity and repetitiveness in the customer's requirements from the bank when they are interacting with the call centers. That is one area. Second, project implementation. Many of the IT projects we implement, because dependency on IT has become more and more. So project document preparation as well as the user tests. There are many dimensions before we go into live the current application, whether it's a fintech application or even in-house developed application or application taken from a vendor. These need to be comprehensively handled when the dimensions of banking have increased because of the dependency on technology. So there, once again, we banks are taking initiative in using AI to create a model documents and model testing mechanism so that comprehensively it is handled and will not be losing anything. Another area is change management, where even AI can be implemented. So as on today, in the financial sector, I don't think anybody has thought of implementing AI in decision-making mechanism. Support can come, but decision will remain based on certain parameters. Even though our retail lending can be structural, where risk scoring model can drive the decision, but in corporate lending, it is a risk rating model where decision making is done involving the individuals. So in the decision making process, as on today, I have not seen any financial sector taking initiative to implement AI, but we cannot discount the uses of AI and we cannot drive away the AI for implementation in the financial sector.
Excellent, sir. I think you have graded the opportunity and the risk in these both these sectors, both the as far as fintech is concerned and AI is concerned, and it has been positioned appropriately. And I think they are very convincing responses to the question. And as far as fintech is concerned, you have taken it as complementary to what the bank is doing, as well as the advanced technology areas with sufficient guardrails, which will be as applicable to the banks when they enter that particular sector, that particular solution. And as far as AI is concerned, I think you have highlighted that it will be more for support and not for decision making, and also the stage at which, the maturity at which they will enter, and as well as where they are being used, particularly with respect to project implication and implementation and customer interaction, where they will begin and a lot of understanding will come. And then perhaps one fine day we may understand the tiger. Thank you, sir.
Look at you for future.
Thank you, sir. Pause my questions here. I hand it back to Professor Rao.
Thank you. Thank you, Prof. Sir, it's an amazing listening to you responding to so many questions. Quite directional, very useful, knowledgeable, and we have got a hang of what are the dynamics in this sector and how it is going to help when we embark on consolidation, and what are the challenges that we need to work on. I'll ask one or two simple questions, sir. When I say simple questions bereft of any jargon, given the subject can be quite scary to people, and we need to make an appeal to the people from non-financial sector as well to understand the whole thing. So therefore, the purpose of WiseViews is to make it very simple and easy to consume. Sir, my first question based on that premise and request is one issue that we are talking about is in the consolidation process, the banks will become larger. Although you have answered this question partly, but the dimension is slightly different. The banks could become larger because of consolidation. If they become larger, will they enhance the credit flow really in real sense towards, say, MSMEs and startups? Because MSMEs and startups are impact sectors where several for youngsters and also non-youngsters are working, and it could be very, very important for our economy. So this kind of scale, does it risk making them less agile also? That's the question.
Right. First, I will address MSME, then I'll come to the startup. In case of MSME sector, we have seen they were in trouble from the year 2017. That was the reason why Reserve Bank of India, for the first time, from 1st January 2017, has opened a window of restructuring for the MSME sector across the country. And that window they've opened for more than 2 years. And suddenly we were impacted by the COVID as well. During that time, Government of India has come forward by providing the guarantee cover even for lending from the banks. So Focus on MSME sector has been there from very long time. Earlier, we used to call, when we started banking career, we used to call at that time small scale industry, retail trade, small business, transport operator. We used to call various segments. They've all now converged into MSME sector. MSME sector is lifeline of any economy, more importantly for a country of our size with a large population. It generates high element of what you call employment, and it can provide, even if at a lower you can say wages for the employment, but there will be employment generation. So concentration on MSME with respect to government and with respect to banks, there is no doubt. We have a compulsion means there is a regulatory requirement of providing 40% credit to private sector, and MSME falls under private sector. And larger industry or medium industry, probably some of them because of the outlay may not be covered in 40% of private sector, but banks are very clearly aware that the risks, in fact, if you calculate, is lower in MSME compared to corporate sector. In corporate sector, if the segment goes bad, entire sector will be in trouble. Or if one industry goes bad, it impacts the bank because the larger amount, whereas the MSME amounts are small. So there is no doubt banks, however large they become, it is bread and butter for them for lending the MSME sector. And I don't see any reason where a bank can go for corporate lending. I'll just take a simple example, I'll tell you. If only corporate lending is required, suppose a bank of PNB size is having 10,000 branches, 500 branches are sufficient. Where is the requirement of 9,500 branches? If only corporate lending is the criteria. 500 branches can lend to corporates by sitting in strategic locations, but that is not the objective. Objective of banking is to lend to all the sectors. 9,500 branches remaining are required only for lending priority sector, agriculture, and MSME segment only. So this will continue. There is no doubt on that. Now coming to the startups. Startups, while India is one of the countries where they have produced a high number of startups. One is domestic entrepreneurs taking certain amount of risk, putting their own money and starting the startup. Number two, after some improvement, investment coming from abroad. Here there are two complex issues. Any startup concentrating on valuation will be very risky in the ecosystem. Any startup concentrating on profitability will have a long-standing impact. The reason is angel investors or other investors who are bringing money into the startup segment, they are more concerned about the valuations. Now, they are ready to put money even if the startup is incurring loss. Incurring loss is not a sin or a problem unless you have a future outlook to earn the profit. But by incurring loss and getting more money from the investor, if you are concentrating only on valuations, I don't think banks also will be ready to take plunge into that, because anytime that startup can collapse. That is not the criteria. If a startup is financially stable and concentrating on profitability and ready to grow consistently rather than developing in the growth, then banks will always have an approach positive to lend them. And I've seen many of the banks have had a credit policy defined particularly to lend the startups. Some of the banks I've seen recently, they've opened startup branches, a branch completely concentrating for only startups in the locations where these startups are available there. So startup is good for the economy, that brings innovation in process and innovation in product. But we need to also look at with a pinch of salt that they are not coming only for the valuation, but for profitability and consistency in the growth.
Thank you, sir. Thank you so much for making these points extremely clear. The first one is categorically the banks are aware of their duties in terms of lending and support to MSMEs, like the way they have for priority sector, like the way they have for agri sector. Similarly, the focus is on MSME, and that remains undeterred. The second point is that there is a defined credit policy for startups among the banks, and in that there is no confusion. While the credit policy is defined, the startups which are obsessed with valuations may not receive the support that they would like to receive, and it could be detrimental to various other sectors as well, and also losing money because if you're obsessed with valuations. Fantastic, sir. Thank you so much. One more hypothetical question, and then I'll open the mic for esteemed members to speak to you directly. And this question is about, do you foresee that the further consolidation of PSBs is to portray banks to the global footprint? Like, for example, do you foresee our banks becoming like Japan's Mitsubishi or ICBC of China?
Ambition and reality, these two need to be properly looked at. Ambition, any economy, any emerging economy would like to have commercial banks, which are critical to the economy, to be in the global vertical listing for the vertical future to come. But we need to also gauge the ambition with reality. What level we are growing, as I have already indicated. Now, amalgamation further will happen or not, I don't say it is a negative sign. Amalgamation can always happen further, but it should happen considering the ecosystem's requirement. If you go back to Narasimhan Committee recommendations, their recommendations are also which came in the year 90s. They told about 4 to 5 banks at the international level, and around 8 banks at the national level, and smaller banks at some level. Today, if you look at, there are 12 banks. Out of 12 banks, there are 5 banks not affected by the amalgamation. These 5 banks are there, still existent. They were not part of the amalgamation. And 7 banks are there, which were part of the amalgamation. Now, there could be a possibility of looking at some convergence among those banks. I'm not forcing that amalgamation will take place, but maybe some scope can be created in future, though the government very clearly clarified as on today with respect to vertical amalgamation not being on their agenda. Now coming to, there were 2-3 other agendas as well for the government. For example, they wanted to privatize IDBI Bank, where the stake of government and LIC are there, State Bank of India and LIC are there. Now IDBI, they were working very hard. Probably we can see some positive movement by March 2026, whereupon there are a good number of suitors who would like to participate. But please look at one bigger challenge is the market cap of these banks is being higher. If somebody wants to come with a 50% stake, he needs to shell down more than almost 25 to 30,000 crores. Much more than that. Initially, they thought of Indian Overseas Bank also, they want to go for privatization. Quite a few banks, even the government themselves have told. But with the capitalization of government coming between the years 2017 to 19, large amount of capital has come for retaining those banks in financial health. As a result, market caps have gone increased. And today, somebody wants to come with 50% stake. Unless 50% is given to him, he will not be able to implement his strategies for running up the bank. So the takeover, now only we have seen, for example, Japan Bank investing in vertical S Bank, and then Development Bank, National Bank of Singapore coming to RBL, National Bank of Dubai, NBD, showing their interest in putting money in RBL as high as 20,000 crores. So the global players are also seeing good value proposition in terms of investing in the banking sector of our country. So we can see some stakes coming into private sector and some of the semi-public sector like IDBI Bank and other things. So those things will happen in the shorter run, maybe in the next 6 months to 1 year to come. But amalgamation, I would see that probably 1 or 2 here and there could happen, but we come to a situation where very few amalgamations, the scope is left. We need to look at the domestic demand and effectively handle that. That is the important requirement.
Fantastic, sir. In simple words, what you have advised is that the primary objective of this consolidation, existing and proposed, if any, is to take care of the parameters of economic growth, the domestic sector requirements as a first priority or a top priority, and then the other things are, of course, one can look at it later. So there is an ambition, but that has to be a measured ambition. That's the summary I gathered, sir. Thank you so much. Without waiting now, I'll request Mr. Venkat Subramaniam to open his mic and speak to you and raise his question. Over to you, sir.
Good evening, sir. I'm Subramaniam speaking. I worked in nationalized bank and then new generation private sector bank for 18 years. So my observation is this consolidation, last time consolidation, and improvement in public sector banks' performance, it has almost, or not almost, it has stopped recapitalization, which was like a bottomless pit once upon a time, 2018, 19. It was like government keep on giving capital without any restrictions or anything. So that is one good thing really happened due to the consolidation. So my question is, sometime back, finance ministry or finance minister, I don't remember exactly, they said that at least there should be 2 Indian banks out of the top 20 globally, asset-wise. That is their ambition. So are they moving towards that or not? Now, right now, if you see, SBI is at the 43rd position and HDFC Bank 73rd. HDFC Bank, of course, private sector bank. Unless you merge some banks with SBI, it will not come to the 20 level, less than 20 level. And one more thing, my observation is, though the Basel Committee norms says that you need to have 9% capital minimum, risk-weighted capital up to 9%, etc. My feeling is Indian banks should keep at least 15% capital, at least 15%, because the kind of exigencies, the kind of capital requirement coming up, you don't know when it is going to come up. So my feeling is it should be at least 15% for the public sector banks. So please, can you comment on that?
One by one, I'll give you. First thing is that the resilience of public sector or commercial banks as on today, I'll give further statistics. The profit at the end of March 25 has been 4 lakh crore, and the gross NPA is at 2.3% currently, and the capital adequacy is more than 17% currently. So it further signifies the resilience they have shown in the commercial banks. Now, coming back to capital adequacy ratio, it is not 9%. 9 plus 2.5 capital conservation buffer. That is 11.5 is the regulatory capital requirement as on today. 5.5 that is equity. 1.5 tier 2, 81 and 2% tier 2 and 2.5 capital conservation buffer. Altogether, it comes to 11.5. Now, as you rightly said, 11.5 is the minimum regulatory requirement. Without taking much of time, there are pillar 2 risks as defined under ICAP. So for pillar 2 risks also, whatever capital is required, you need to adjust against the existing capital, and then only you can calculate risk-weighted assets, number one. Number two, the baseline scenario is different and severe scenario is different. So when we submit the ICAP document, you will have to provide those categories as well. So as a result, while I am agreeing with your point that the capital minimum, 15, even it should be more than 15. But the minimum capital requirement itself is not 9, it's 11.5 plus pillar 2 plus other factors. And only then the calculation happens through the ICAP document. Now, coming to what is the other question you said regarding the consolidation?
Yeah, large banks within the top 20,
one or two
large banks.
Trajectory of global. Now, see, that's what I said. Finance Minister has indicated with a positive frame of mind, considering that the country will be third largest economy in the years to come, number one. Number two, we are ambitious about achieving $5 trillion economy by 2029. These are the main factors in front of them. When these are there, simultaneously, the banking sector also has to grow to become a reckonable, financial sector across the globe. We cannot read very mathematically out of that. If you want to read mathematically and back calculate accordingly, even if you are growing your GDP at 8% consistently and looking at around 18 to 20% credit growth in the next 5 years to come, still it would be difficult for one of our banks to be in the top 10, considering the fact that the other banks which are there in the top in the economy, they are also growing, they are not degrowing. So the question is, we need to be ambitious to move in that direction, create the environment in that direction, and allow the system to grow accordingly, rather than prefixing our position to be at number 1, number 2, or number 3. It should be a corollary rather than creating a goalpost. Because domestic growth, domestic economy, propelling our economy to 5 trillion and becoming a third largest economy across the globe are our basic factors for which the commercial banks as on today will have to contribute, work as a catalyst for improvement in the economy.
Thank you, sir. Thank you.
Excellent, excellent. Thank you so much, sir. Very, very clear. Can I now request Dr. Amit Badra to speak, sir?
Thank you, Professor Sudhakar Rao. Thank you, Mr. Mallikarjuna Rao, for the masterly presentation. Very, very informative. Sir, I have just one small question. Public sector banks traditionally had a social responsibility.
Correct.
So that was one of the reasons why they have been less profitable. So now, do you think there's a rollback in that position of taking up social responsibility?
There is no rollback. First thing is that many a time we think that social responsibility is not profitable. Probably that is not a correct, altogether a correct statement. Though when we started off public sector nationalization from 69 until 91, whatever growth has happened, the sole objective was social outreach, financial inclusion. Definitely at that point of time, probably the expenditure was higher than what the banks were earning. There is no doubt on that. However, today, if you see the way economy has propelled, there's nothing called social economy. Today, if you look at the 2.7 lakh crore outstanding is there in the Jandan accounts, and banks are earning out of that. And that amounts are majority of them is laying in savings accounts where they are earning only 3.5% who customers, whereas the bank is using that money as effectively in lending. So I don't think today social banking is a non-profitable proposition. Every bank is earning profit out of social banking. We have come to a situation where a large canvas has been created. Only thing is there may be still few segments where we need to concentrate effectively from the government side to ensure that the credit goes there. That is the reason why priority sector lending norms are still prevalent. Probably once we become a developed economy, it will become a market-driven lending to any sector because every sector becomes matured. So my point is social banking is relevant as on today as well, and it is not non-profitable, it is profitable. It is the way of prudently handling the sector by the commercial banks because we have come to a very good canvas in our country that can take take us forward in terms of the banking.
Right, sir. Thank you very much. Thank you, sir.
Thank you, sir. Thank you very much on that. Very quickly, I'll request Mr. Sailesh Davla to raise his question.
Good evening and namaste, sir. Thank you for such an energetic presentation. Really inspiring and an honor to actually listen to you. So I have two questions. The first one is mostly from an urban private sector employee. Okay, if you look at private banks, okay, they clearly lead in customer experience and service agility, right? And you can see the difference. Like I go to any private sector bank, large private sector bank, versus I go to, let's say, a state bank and syndicate bank, right? So the difference in the experience is stark despite so much of transformation and so much of progress, right? So what are like PSBs doing on that front? And is urban center sort of a private employee private employee is your consumer to so that's one. That's one question. And also secondly, like you kind of gave away the sort of sector commentary and so much of these numbers, hardcore execution as well as strategy, all of that, right? So how do you personally stay motivated and kind of enjoy this kind of high passion and energy for the banking sector?
The first question is, while I may agree partially, I may not agree fully. The reason I'll tell you, private sector banks, when the license was given for the first time in the years 93, 94, and they've established, they came with an advantage of technology riding on their banking services and starting everything from zero, as a result of which they had a choice to reach out to the customer, and they had a choice not only to select the customer, they had a choice to follow the process what they like. Process means technology driven process. Whereas in case of public sector banks, there is a legacy in front of them and they have to handle everything. So as a result of which, number one, first is legacy related burden on the public sector banks. I don't say burden, the customer base sitting on them expecting the business to be done. Now, private sector banks, once again, over a period of time, in the competition to remain, because if you look at public sector, business was as high as 90% in the year 1991, which is now currently around 59%, 58-59% in the market share. Now, this kind of a market share from 90 to 59, this reduction has happened because private sector banks more have come and they have taken their market share. So if they want to take the market share from a public sector bank where the trust value is very high and loyalty quotient is very high in the last 3 to 4 decades, they worked on very efficiently in terms of reaching out to the customer with respect to last mile connect and understanding the customer need personally and satisfying the requirement. So their service standards definitely were driven by the objective of getting more business and creating a market share from themselves. And the greatest quality of them is that they maintain that over a period of time. This is a challenge for the public sector. Now from 2000 onwards, when the public sector also has adopted a core banking solution and have introduced latest technology in terms of channels and mobile and internet banking, as far as faceless banking is concerned, the difference between customer service between private sector and public sector has blurred now. Now still the question remains with respect to how you are able to reach out to the customer. Suppose I'll give a physics example. If some article comes into an orbit, it runs into the orbit for longer duration of time until some centrifugal or centripetal force works to bring it inside or throw it out. So one is throwing out from the orbit, another is coming into the orbit. Now, if a customer somehow out of any channel through internet banking or mobile banking or through advertisement comes into the orbit of a bank, it is the responsibility of the bank to bring the customer into it and serve him. If it doesn't, he will go out tangentially at some point of time. So coming back, private sector capability to bring the customer inside in terms of percentage as on today continues to be still high, but public sector is not behind. They have understood and they are coming. There are some structural differences in terms of handling the employees. For example, in private sector, more and more outsourced employees are there. In public sector, it is lower. So these service level arrangements, delivery of service, ensuring performance, these are all the factors where probably you will find some element of gap, but I don't see this as a systemic gap. It is just a matter of time before the gap between these two segments of the banks is reduced. Now, over and above that, kindly remember the trust factor and loyalty factor is still high in public sector. If you look at the CASA ratio of public sector, nowhere any private sector comes near to that. That is because of the factor. Again, if you look at the third generation, first generation, second generation, if they are banking with public sector, probably up to second generation they are remaining, but third generation is moving towards private sector. So public sector is clearly aware of all these root causes which need to be addressed. They are working on that. The difference may still remain, but it gets reduced over a period of time. Coming back to the question related to me personally, it is always required to keep abreast of the things which are happening. Currently, I am on the board of Axis Bank as an independent director. I am also on the board of Indian Financial Technology and Allied Services, which is a 100% owned subsidiary of RBI, and a divergent company called Nuclear Power Corporation, which gives me a wonderful element of learning. So age and position do not make any sense if somebody wants to learn. It is not a prerogative for those two, but it is equally applicable for anybody. And that's only keeps the motivation levels high. Thank you.
Amazing, sir. Thank you so much. Before I compliment you on what keeps you fueled in your passion for banking or learning new things from the Nuclear Fuel Corporation, the answer that you have given in terms of the fact that customer acquisition methodologies employed by private banks could be a notch higher, whereas the trust that is elicited by the public sector banks is much, much higher compared to private sector banks based on service, based on reliability, so on and so forth, which is leading to greater satisfaction of the customers as well. Dr. Amit Badra also has mentioned the same. Great, sir. Thank you so much. If you permit, we will take one last question for this Friday evening, sir. Mr. Lakshmikant Srivastava, please go ahead.
Very good evening, sir. I am your old Shishya.
Yeah, good evening. How are you?
Sir, my question is, what will be impact on the credit cost for RAM, retail agriculture MSME post further consolidation, as liability side component is going to have a drastic change with the exposure of the international level and bonds, etc.
So the credit cost is not dependent on the sector. It is dependent on the NPA accretion in a particular sector. if you look at, that's why I have indicated earlier that our gross NPA currently of the commercial banking sector is 2.3% as at the end of March 2025. So when the NPAs have come down, I don't think credit cost is a criteria. Only thing is, in case of RAM sector, if the sectoral problems externally do occur, the incidence of NPA can be very high. If you look at in the year, that's what I've given an example of 2017 when MSME was continuously in trouble for more than 2-3 years. RBI has come out and gave a opportunity of restructuring window, opening them for an element of 2 years. Precisely the reason is they did not want the sector to become NPA, whereby the credit cost on banks will be very high. Now they came a long way. And if you look at last 1.5 years back, the RBI was cautioning the banks against going for more consumption loans or personal loans, like what you call consumer loan or even housing loan may be secured because of mortgage. But if you are not properly seen the repayment capability, that also will be struck. Then vehicle loans. So naturally, whenever there is one sector where the increase is happening, probably beyond the regulators' understanding of the reasonableness, they are coming out with a guideline, and they are also coming out with a regulation by saying that I will increase risk-weighted assets for this particular segment. So there are enough checks and balances, and what we have seen as a high NPAs in corporate sector and otherwise, they were because of certain situations at that point of time. And I don't think now in future such kind of a situation will be coming en masse to impact the health of the banks. Here and there, some of the NPS coming up is a business phenomena. If you are doing a business, these things do happen. So long as you are able to control within your parameters, I don't see any reason why there will be a larger impact. So credit cost today for a private sector bank is as low as 0.2 or 0.25. In public sector banks also, they brought below 1%. So it's the greatest achievement because NPS have come down.
Thank you, sir. Thank you.
Thank you, sir. Thank you so much for being so patient in answering wide-ranging questions. Some of the questions are actually doubts. Some of the questions are queries to learn a little more from a veteran banker like you. But we are quite amused by the way you have delivered this masterclass on banking sector. Although the guiding topic has been the PSB consolidation as a catalyst to higher economic growth in India. But then we got this opportunity of learning quite a bit when you have looked at the challenges, risks, opportunities, and also the new age pulls and pressures that we have with the technology coming up and startups posing a challenge of a different kind. Altogether, it has helped us, stay grounded. Our faith in PSBs remains actually unshaken, both as a customer and also as a learner. When we today sit down and talk to you and understand from you, it remains firmly rooted with the PSBs. We hope this sector will move towards benefiting all the stakeholders in the ecosystem before we reach out to making that impact on the global footprint itself. I think as you have rightly mentioned, the primary responsibility is to take care of the domestic requirements and then have a desired magnitude of the size of the economy, and it will automatically address other issues. And whatever is beyond that is an ambition, but that actually does not really impact our plans and desires to shape the banking sector currently in India. Amazing, sir. I want to also thank all the wonderful questions that have been keyed in initially by the participants before joining. And also after joining, they have raised new questions to ask you directly. I think this interaction is pretty useful. I have really enjoyed moderating this session. More importantly, the credit goes to you, sir, for making it so simple, easily understandable, and explaining it is otherwise a complex sector, from a distance. But I think this masterclass has helped us understand deep into the dynamics, and we have gained the perspective of a leader like you in understanding the domain of banking sector. Thank you so much, sir. I think on behalf of Dr. Prasad and on behalf of everybody at ICFAI, I would like to stay in touch with you and thank you from the bottom of my heart.
Thank you, everyone. Thank you.
Great. I also would like to place on record Dr. Anita Raman for connecting with you, recommending your name, and we have learned quite a bit. We will come back with a summary of the session and share it with you before uploading on our website, sir. We will use the PPT that you have mailed to us as an aid to develop a summary. And I will keep in touch with you myself after the session as well, sir. Thank you so much. So, ladies and gentlemen, we will meet again, and that is on Friday next, December 19th at 6:30 p.m. Till then, keep learning more about banking sector, and the trust of the PSBs among customers remains pretty high and strong. And let's move towards making Indian economy more performance-oriented, higher growth, and result-oriented in the objectives that are set out for the PSBs. Thank you so much for the leaders like Mallikarjuna sir, and we keep learning from him. Thank you so much. Good night and Jai Hind.